Welcome to On the Mark. I'm your host, Mark Rubin. I am so excited to present this podcast series addressing our rapidly changing world and how it is affecting industries and people in unique and interesting ways. As John F. Kennedy once said, change is the law of life, and those who look only to the past or present are certain to miss the future. The business leaders and personalities who I will be interviewing in these podcasts certainly look to the future. And I hope you come away with information and inspiration that helps you adapt in both your business and personal lives. You can find these podcasts on all major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, getsplatzer.com. Welcome to On the Mark. Today we're going to be discussing insurance brokerage and its industry with Jeff Rubin, who's the Executive Vice President for Hub International, which is, I believe, the fifth largest brokerage in the United States. I normally don't have to say this, but I know a lot of you see we have the same last name. No, Jeff is not my father. It's just a coincidence. Rubin's a very common name, but there's no familiar relationship that I know of between us. Would you agree with that, Jeff? We're not related in any way.
Not that I'm aware of.
Okay, good. So Jeff, why don't we're talking about the insurance brokerage industry today. Why don't you tell me a little about Hub and what you do with Hub?
Absolutely. Yeah. Hub is the fifth largest broker in North America, the largest privately held broker. And we are a full service insurance and risk management company. So we really do everything from commercial insurance, employee benefits, personal insurance, wealth management, surety, the whole nine yards. My particular area is in commercial insurance. I've been in the insurance business for over 35 years. That's where I stop, Howard. I could keep going, but I stop at 35. And my role is I have an executive role at Hub, obviously managing certain operations, and also I work as a client advisor, working with CEOs in the C-suite of commercial businesses to give them guidance on insurance and risk management. And it's a fun job because in our business, it's like, I guess with you, in the law, being an attorney or an accountant, every business that you work with, you learn their business. And it's so interesting to look at under the hood in many businesses and try to determine the risks and understand their businesses.
So the focus of these podcasts are how technology and AI has affected businesses. So I know in the underwriting part of the insurance business, there's been a tremendous influence by things like Snowflake and Lemonade in how they're doing the underwriting part of the business. But that's not the part of the business we're discussing now. We're talking about more of the brokerage end of the business, what you do. Is it, what do you find that clients require or desire in the brokerage part of the business from their brokers these days? Has that changed at all? Are there other services that they're looking for that they didn't, that they want access in ways that they couldn't get access to information before? How do you find that it's been a change, if any?
No, that's a great question, Howard. And because the business is so broad, there's different answers for different segments of the business. In our personal lines business, someone who has some homes or an apartment, a renter, have an auto, maybe they have a boat. In the personal lines business, they want access to their information 24/7. So giving access on an app or technology through the web is very important to them because they're working hard during the day, and then at night they remember, oh gosh, I forgot to add this piece of jewelry, or I'm removing a location, I'm moving somewhere. They want to be able to do that all the time. So we have to change our method from email and phone calls to be able to be on top of that and provide that kind of service. On the commercial side of the business, large businesses, they may be spending $250,000 to $3 million a year on their insurance. They're not looking for that necessarily. They don't expect to add $100 million building to their policy online, right, or on an app. However, they do expect us to use technology to better purpose their insurance spend. And in that area, we are, I would say that one of the most important drivers in any business's insurance spend are claims, because claims will ultimately result in either higher or lower premiums. And we use AI, we use technology to look at the claims that a client has and look for trends. What's happening? Are you getting a lot of claims in one particular location? Is it from a particular line of business? Is it the auto? Is it the comp? Hey, is there fraud? What's happening? So that is augmenting what we can do to, more finely focus on what the issues are to remediate problems.
So let me take it as an example, because I know that you've done work with some of our companies, some of our lawyers. Let's talk about malpractice insurance, which I think is something that lawyers, malpractice insurance, I think is
Sure.
something you. And I know historically, the setting of the rates depends on several things, among them claims made, types of practice that someone practices in. If there's doing securities work, it's a much higher, it's a much higher risk that the carriers have found as to other types of practices. How has it changed? Do you see in how the ratings or how malpractice rates have changed? What do the companies look for now? Has it changed at all as to what they would have been looking at 5 years ago? Do they have more precise data? Because I believe my understanding of AI is that what it allows the insurance companies to do is get more precise data and to focus on risks on a much more accurate basis than they could in the past. Have you found that to be the case?
Yes, 100%. The underwriting syndicates, whether they're big companies like CNA or Zurich, or they're more of a new entrant into the business, the underwriting team may move from one group to another, and they use technology to level the playing field. They will know, based on aggregating data, where the claims are coming from, exactly as you articulated, Howard. If an attorney is working primarily in securities, and there could be a lot of volatility and a lot of people losing money, in securities, and a lot of scrutiny, they can identify, okay, in all of the states, where do we want to stay out of? Do we want to stay out of New York? Do we want to stay out of Cook County in Illinois? Do we want to stay out of Houston or Texas? Or do we want to go there? So they can use technology and look at the awards and look at the judgments and look at the reserves on a geographic basis to determine where the most risk is. So that's definitely doing that. And I think that because it's the technology in producing the attorney's professional liability policies. If one underwriting team is in, I don't know, let's say Allianz for the sake of argument, and they've been doing it for 25 years, but that team leaves and now goes to, I don't know, core specialty, and they can immediately open up their business. They know the rates, they know the forms, they know where to get the information, and it's very fluid. So I think there's more, there's different players in the market than there were 5 years ago. They're not the same players, and we have to counsel our clients who really just want to deal with a brand name insurance company and understand that, hey, if it's A rated, and it's the same team that was negotiating for you and underwriting you with a name brand, and the security is there, the financial size is there, it's worth taking advantage of the savings.
There areas that all the carriers are leaving. I know there are certain states or certain types of insurance that have not been profitable for carriers historically. And a carrier is entitled to, I think, has a right to leave a state and say, I'm not writing this type of insurance, or I'm not writing insurance in this state. Do you find that that your customers, your clients, have less choice in carriers to get the type of insurance that they need than they did, say, 5 years ago?
Absolutely. when you think about what's happened in California with the wildfires in the Pacific Palisades, almost all of the big name insurance companies have pulled out of California in that area. So as a result, Lloyd's of London, who is not a typical name that you would go for your homeowners insurance, is now writing a lot of these homes, or the rebuilding of these homes, in those areas. Florida has always been, as I'm sure you know, a very fluid market, right? 5-year period, you could have a lot of insurance companies writing in Florida. Then the wind blows a few times in a few years. Everybody gets out, and then it's Citizens and other, government-run programs, and then they come back. With anything else, it's our business is very, very cyclical, and companies will chase profit. And if they believe that, okay, now 3 years later in the Pacific Palisades, every home has been built of concrete and really strong materials and flame retardant, and even if there's wildfires, we've got gullies that'll protect them, and firewalls. So there's technology and there's engineering that can be performed to make them desirable again. But it takes time. The carriers have to pay. Last year, in 2024, there were $3 billion of catastrophe claims in this country, which dwarfs the prior decade.
Does state regulation affect what carriers want to be in a certain location? In other words, I know some states don't want to, some carriers don't want to be in states that have malpractice claims because of state regulation or how litigation is. Is there a lot of carriers making decisions based on the regulatory authority of a particular state?
Absolutely. New Mexico, you can hardly find an insurance company that'll write liability in New Mexico because of the way the courts are set up. There's just very little protection for the policyholder. Philadelphia, we now have, as you know, venue shopping. So where you could have had a case tried in Lancaster County, now it doesn't matter where in the state of Pennsylvania the claim occurred, they're going to bring it into Philadelphia with a very different jury pool. So yeah, absolutely, the connectivity between government and regulation and insurance absolutely affects the availability and cost of insurance.
And let's talk about the areas of insurance. I mean, I remember 10 years ago, I never heard of cyber insurance. There wasn't, I don't know there was such a thing as cyber insurance. Maybe there was, but I wasn't aware of it. Terrorism insurance that, before, I think 9/11, people were unaware of terrorism.
Terrorism, exactly.
As something that they had to protect against. And I had a client that was very disappointed because he was affected by terrorism. His was to blow up at the World Trade Center, and his car was in it, and it destroyed his car. And he thought he had car coverage. And no, listen, the terrorism exception in the policy, which no one at that point knew about because we never had that issue. I know that there's been new areas of insurance that your clients would have to be taking out now, or should be considering. Can you go through some of those areas in the last few years because of world events, where people should be relooking at companies should be relooking at their policies and maybe either taking insurance or increasing the amount of insurance that they have?
Absolutely. Cyber is probably the best example of an exposure and a policy solution that has really been a result of what's happening in the world. And as we all know, these bad actors, whether they're in Iran or they're in Russia or wherever in the world, they're hacking into businesses and finding them very vulnerable. And before, in the first couple of years of the cyber awareness, a hacker would come in, disrupt your computer system. You would have it stopped. You would have to then monitor credit for all the personal information that you keep on that system for at least 12 months for your employees, your clients, and so forth. And then the restoration of the computer system and any business interruption would be covered by cyber. Then you get into the next wave of what we call social engineering, where the bad actors are fooling us or tricking us into voluntarily parting with money. You have a Chase app on your phone and you get a request for a transfer. And it's your company, you do this all the time. You just press the button, boom, the money is transferred into the operating account. Now it's going to Kenya or going, to Belarus. So then we created the social engineering component and tacked that on to cyber. Then we got into, okay, it's not enough to hack into a system. It's not enough to trick you out of money. Okay, let's hold you up for ransom. Let's go to some of the largest companies in the country and stop them on their tracks unless they pay millions and millions of dollars of ransom. Or for smaller companies, I've had many local companies, the ransom comes in, they freeze your system, and then you have to pay the ransom to unfreeze it. And generally speaking, there's honor among thieves. Once they once they take the ransom, it's good. But then, of course, the policy had to be adapted and endorsed to change to cover like a kidnap and ransom policy, basically, except it's financial ransom, not an individual, being held for ransom. So as you can see, in probably the 10-year period, we've added 3 or 4 more factors to provide coverage within the cyber. That's one example. Another example would be on your employee dishonesty bond, right? And almost every business has some sort of employee dishonesty crime policy. The old story of someone that's worked for the company for 30 years, they were the bookkeeper and they were siphoning off money a little bit every year. You report it to your insurance company, you get the money back, and you unfortunately you report the person to the police or you fire them. But it's gotten so much more than that now because there's electronic fund transfer. People can be tricked into sending millions of dollars wires through a fraud transfer. So if you do not have an appropriately endorsed bond and an appropriately endorsed cyber policy, you're not going to be covered for all of these potential risks that are out there today. The other one that it's a little bit older, but I think it's still important to talk about is employment practices liability. When we first started selling employment practices liability, it was primarily for sexual harassment more than anything else, and it's morphed now to wrongful termination. Everybody, as you know, in this country, other than maybe 35 and under, are in a protected class, and they can go to the EEOC and get representation for free and sue for wrongful termination, for all different types of causes, and those have become big dollars. And then on top of that, now if someone is in a position in a company that should be getting overtime, maybe shouldn't be getting overtime, or certain wages, they now go after the company for wage and hour discrimination. And we have to add wage and hour endorsements to policies. So you can see that maybe something that's been around for a while, it changes and is adapted over years to cover the risks that are out there.
I found from my experience dealing with getting underwriting for some of these policies, that the carriers put very strict rules. In other words, before you can transfer money from one account to another, there's got to be this kind of a specific system that has to be gone through. And if you don't do that, they're not going to cover the claim because they require you to do that. So the burden, to me, it seems like that the insurance companies are shifting a lot of the burden to the employer and making sure they're very compliant. Now, that's not necessarily a bad thing because there should be good practices in a company, but the company itself has to be very careful in making sure they're complying with this, or they face the risk of not having coverage for something that they thought they had coverage for. Do you find that to be a problem in with some of your clients and their compliance claims rules?
Yeah, I mean, I would term it more of a partnership in those types of situations where the insurance company is giving you their capital for something that you know you're operating as safely as you possibly can. You've got the multi-factor authentication. You've got two people that have to sign off on it, transfer over X amount of dollars. They're going to come in and have hackers try to get into your system to make sure you have the most accurate patches. And as a result, they charge premiums that are far less than what the potential losses can be. So I think that's the economic, it's the old adage in insurance, right? Trading certainty for uncertainty. If you want to have certainty that you're going to be covered, for these various risks, you have to comply with certain procedures that ultimately protect you. And no matter how many protections you have, and no matter how vigilant you are, sometimes the hackers or the bad actors, they still get through. And then you're really happy to have that policy.
So how does how does an employer monitor whether they're complying with all of the rules of the insurance company so they don't risk not being covered? Is that something that you get involved in at all, or is that something that you leave between the insurance company and the client?
No, no. I mean, that's a big role of the broker in every facet. So a few examples: property insurance. We bring a office building to Chubb, and we get the quote. And Chubb says, okay, we're going to base this on the fact that they've got sprinklers, they're working sprinklers. It's X number of years, et cetera, et cetera. And then the policy comes out, and we have to follow up with the client to make sure that they've got the right sprinklers, the right this, the right that, and have the documentation, that it is. Sometimes a insurance company will come out and inspect, 30 days, 60 days, 90 days later, and we had represented that the roof was 5 years old. Turns out the client forgot. It was another building that was 5 years old. This roof is 20 years old. Okay, well, then the insurance companies come back and say, hey, you got to update the roof. But we can't do it in one day. We've got to put it, so it's our role to negotiate time and appropriateness of the recommendations that come from the insurance companies. Same thing with recommendations. We insure, probably, 10,000 buildings in the area, a lot of habitational buildings. And in the Bronx, the sidewalks get cracked. And if the sidewalk law, now the building owner is responsible for, fully for someone who slips and falls on the sidewalk. So the insurance company goes out and inspects the building, and they inspect the sidewalks, and say, hey, we're going to renew you, but we expect you to repair this sidewalk within X amount of months. Then it's our responsibility to stay on top of our clients, remind them, because we don't want to have a situation where the policy gets canceled because they didn't adhere to the recommendations. We try to be as proactive and customer friendly as possible in these situations, but we in order to provide coverage in an area that is pretty scarce from a lot of competition, like habitational, in the Bronx, we have to negotiate and the best terms possible, with the insurance company. But we also have to, discuss with our clients the need to comply with these recommendations. And it's not a great conversation. No one wants to spend money. But
Now, I want to talk about the role of a broker a little bit more. The broker is representing the client. The insurance company you don't work for, you're on their panels to write insurance for a particular brokerage company. Now you make representations, right? The client makes representations that then pass through you, that goes to the insurance company. Do you take any steps to verify the information that the client is giving to you, or is it something that you're just a pass through for information?
yeah, no, that's a great question. With respect to property, there's a lot of public information out there, and we gather that information. So when we put together a schedule of locations, we can find out the year it was built, the year there was some improvements, sprinkled or non-sprinkled, what's in the boiler. And so we'll provide that information to the underwriter. There's certain types of policies where there's just no way we're going to know. If it's a manufacturer of iPhones. We just can't, we're not privy to the information on how many iPhones fail or how many iPhones cause bodily injury. So we have to rely on the representations, of the client. So where there's public information that we can gather, prior information, having a legacy relationship with the client, a lot of the information that goes to the insurance companies, we already know and just update from year to year. When it's a brand new client, we get as much as we possibly can from public information, but then we really do have to rely on the representations of the clients.
So you're not you don't act as an agent at all. You're strictly a broker, is in terms of meaning who you're representing. You're strictly a broker, and there are no lines of insurance. Would you act as an agent for carrier? Is that true?
That's true. Yeah, I can't say that within all of Hub that's the case. We do have some program business where we act as an agent on behalf of an insurance company. But for my world, for 1,100 employees in Hub Northeast, we are a broker, right?
Okay. And when you say that there is some variance between commission rates, is the variance? I know you said that the amount of commission is disclosed on a particular policy that they're underwriting, but is the when you get the quotes, is the quotes that are given to the client, are they disclosed as to what the broker is receiving from each of the companies, so they can see what the broker is getting, or is that something that's only at the end?
It really depends on the client. Some clients want complete transparency. They want to see every penny, and some clients are very happy with the service, and as long as the bottom line is good for them, they're good.
Okay, so in the real estate industry, I'm going to make this as an analogy. There's been somewhat of a recent change that a real estate broker is allowed to kickback's the wrong word, rebate to the client. Rebate is the right word. Rebate to the client a portion of its premiums, which is something that's negotiated between the customer and the real estate broker. In your industry, for large clients, I'm sure you have some very large clients. Is there any rebating to clients from a brokerage? Do they try to negotiate that, or is that something that doesn't exist within your industry?
It's actually illegal in our business. If we rebate to clients, we'll lose our license.
Okay, so
we can only share commission with licensed insurance brokers.
Okay, so that's different than the changes in New York, at least in the real estate industry. Is that correct? Because the real estate industry, with your customer, you're allowed to rebate even if they're not a licensed broker. Do you do a lot of co-brokerage work at Hub? Is there usually? I mean, I know that you have clients and that you underwrite for clients through Hub. Are there a lot of situations or some situations that you work with a co-broker who's working not for Hub but for another company, and then you're splitting the commissions? Does that happen a lot? Is that part of the business?
It's not a big part of the business, at least on the retail side. There are certain situations where perhaps someone in life insurance or someone in employee benefits insurance who has no property and casualty operations or outlets would come to us and say, "Hey, I've got this great account. Would you work on it with us and share commissions?" And that's usually at the discretion of the sales manager and the individual producer if they're want to do that. In terms of open brokerage, on a regular basis, is sending in submissions. We have certain programs that are part of the overall Hub, not part of the retail operation. It's called a wholesale broker. So we own Program Brokerage Corp. We own Swiss Specialty Wholesale Insurance, and they have certain programs. We own the Mechanics Group. It's a group that insures security guards. We own Weisberger, a group that insures exterminators. We have a number of programs out there. And in those cases, any broker who wants to develop a relationship with the wholesale part of our business can submit business for these programs, but not for, not coming to me or my colleagues and saying, hey, I'm ABC broker in the Bronx, hey, Hub, can you market all my business, general business? No.
So if a broker has a small broker has a small maybe a relationship with one or two carriers, but they want to market it to more carriers, and Hub is, I'm sure, because Hub is so large, has relationships with basically all of the carriers. Could they go to Hub and say, hey, we have this client that wants to write, and we'd like you to go to Chubb. We're not Chubb and some other companies which we're not, we don't have a relationship with, or we're not privy to, and use Hub to get quotes from those carriers. Does that happen?
Not really, because when we submit business to an insurance company, we want to have the reputation that a piece of business from Hub has been vetted out. The information is accurate. We've looked at the losses. We're not holding back any loss runs. If there's a bad loss, we're going to find out why it happened, when it happened, why it's not going to happen again, and give that information for the underwriter to make a decision on. And we also put behind that all of our value based service. We have 100 risk services employees that do training and loss mitigation and disaster recovery and lifting training, driving training. So all of this is going into our submissions. So when our carriers get our submissions, they know they're getting a submission from Hub with everything that goes behind it. If we just take a piece of business, even though the premium's great, from a local broker somewhere else, and just submit it as though it's ours, it's bad news. It could impact our reputation, and it's just not worth it.
What happens in a situation? I don't. This may be a legal question, but I don't think it's a legal question. What happens in a situation that you find out, you meaning Hub, finds out that some disclosures of the client either have been not accurate, or has changed because maybe someone's been indicted within the company or something like that? Do you have a duty of disclosure, or are you allowed to disclose that to the insurance company? How do you handle that, if at all? What's your obligation?
Well, if we know that there was material misrepresentation in an application from a client, we have to broach that with the insurance company, because if there's a claim, it's going to be denied. And I'd rather our client understand where they stand with their policy and the carrier where they stand with the policy. If something happens internally within a company and one of the directors gets indicted, that's not our obligation to advise the insurance company. There's still a company there with the other additional executives, and things happen.
So if you have a situation that you're representing the customer, you're not representing the insurance company, and the customer says to you, because the customer's told you, gee, we might have made a mistake on some of the numbers that we gave them, and they tell you this, but they say to you, but we don't want you to tell that to the insurance company. We want to do more of an investigation, and we'll tell them after we finish our investigation. Other than going to the general counsel at Hub and asking what you should do, how do you think that should be handled?
Actually, it's very common. All policies are based on exposures. So a contractor, right, based on payroll; a manufacturer, based on revenue; workers' compensation, based on payroll. So if a client thinks they're going to do $3 million of payroll and their workers' comp is $200,000, and during the course of the year they double, and they don't want to pay it immediately, they want to pay it when the audit comes in, that's fine. They can wait and pay it when the audit comes in, and the next year's policy will be adjusted. General liability, workers' compensation are all audited. So you start the year with an estimated exposure that the policy is based on. At the end of the year, an auditor comes out and trues it out. And if they underestimate it, they've got an additional premium. If they underestimate it, they could get a return premium. So it's it's well policed in that way. If a client tells us, hey, I'm a security guard company, but I've got a contract to do high-rise window cleaning, and I really don't want to tell the insurance company. We would let them know, look, you're the client, but if you have a window cleaning claim, it is absolutely positively not covered. And I can't give you a certificate of insurance to a building owner representing that you're a window cleaning company. So it's a conversation.
Now, what would you say to someone that says, really, commercial insurance is a commodity? That if I go to Hub or I go to a competitor of Hub, another large competitor of Hub, they're going to go to the same companies, same insurance companies, and those insurance companies are not going to give different rates to different brokers. The brokers are all going to get the same rate. There's no. If I'm wrong about any of this, when you answer, you can tell it. But
Yeah.
all the top brokers are going to get the same rates based on the same facts. When underwriting insurance, how does Hub differentiate itself from its competitors, if they do?
We absolutely do. And I would say for the top 20 brokers that are out there, we all play in different levels of business. But we provide such a volume to so many insurance companies, and I can, at least speaking for Hub, know that we deal ethically and transparently with our underwriters, that we can get better rates than someone who doesn't have those kind of relationships, have those kind of resources, and operates ethically. Because commercial insurance, it's not slot rated. If you've got a big apartment building, if you've got a big office building, a factory, a technology company, a huge contractor, they're not set rates, they're negotiated rates. And underwriters that you have a good relationship with and give a lot of business and are always truthful will want to give you the best rate they possibly can because they want more of that. They don't want a broker that's sending in fraudulent information and cancellation notices every other day. So, I would say the clout of us or one of the larger brokers out there does make a difference. How that broker translates that clout into working relationships and excellent working relationship with carriers do provide different rates than they may provide to others that they do not have those kind of relationships with. Having said that, if I am in the small business world, the BOP, what we call a business owner policy, it's a chiropractor's office, it's a doctor's office, it's a small wholesale company, and we go to 10 insurance companies online with the information and we get 10 quotes, chances are they'll be very similar to 10 quotes that the Hartford or Travelers are going to provide to 100,000 other brokers because it's slot rated. There's no variation. It is transactional. We have access to more companies probably than a smaller broker, and we can compare rates and know which to go to for the best rates. But at the end of the day, the rate we're getting is going to be the same as others get. But I'm talking about that small business, like 15,000 in premium and less, $3,000 in premium.
So, how would you, if you can get better rates than smaller brokers, and Hub is number 5, does that mean that number 1 and 2 can get better rates than Hub?
Well, like I said, I think we all play.
We won't identify who 1 and 2 are, but I'm just
Yeah,
talking about
it kind of self-selects. We're Hub International, but we're really North America and Puerto Rico, right? We don't have 1,000 offices across the globe. If I'm dealing with, Google or another, company that is a global company and they want to work with someone that has boots on the ground in every single office, then some of my upper level competitors may be a better choice. But if it's a company that is the decision makers are generally the CEO, the CFO, they do not have a professional risk manager, and they want a broker that can be that risk manager and their partner and their consultant, then that's the area that we excel in probably better than our higher level competitors.
Okay, well, Jeff, I think we're at the end of our time. I think you've gotten, I think your points across. I think it's been an interesting conversation. I hope I didn't put you on the spot too much. But thank you for appearing on the Mark. And if anyone needs in the commercial lines of insurance, Jeff is someone that we've worked with in the past, and is very diligent in what he does, and Hub's a great company. Certainly someone to consider. So with that, I would say thank you for being on the market, Mark, and we'll see you in the future. Thank you. Bye.
My pleasure. Thank you so much. Really enjoyed it.
Bye.
I hope you enjoyed this episode of On the Mark. I started this podcast by quoting John F. Kennedy and would like to end it with quoting one of my favorite baseball players, Nolan Ryan. Enjoying success requires the ability to adapt. Only by being open to change will you have a true opportunity to get the most from your talent. I wish you success in staying ahead of the curve instead of behind the 8 ball. Thank you for tuning in.